Okay, here we go. Chapter 5, and this is mainly going to be just the whiteboarding of purchase type entries and sales type entries. This is my second shot at it. You won't see the first shot, so I think this will be a little more efficient. And it's Friday, October 15th, 2021. And it's one of my birthday presents, so I think you want to see that. And it's a beautiful day. Everybody, I sit, trying to make this chapter a little bit easier. So let's start with this. This was on the screen the other day in class. All right, so this is the summary of the purchasing transactions that we focused on. I'm going to whiteboard these and one more. So on the left, but I'm going to talk through the slide and then we'll do the entries. On the first thing, we buy $3,800 of inventory, and that's of course debit inventory and credit accounts payable, and the nature of that is the purchase of inventory. That's why it says purchase. On May 6th, we pay the freight company $150 because we're paying the freight on the inbound goods. That's a component of inventory cost. In this case, it's $150. We'll debit inventory. You know, the nature of that is freight in, and credit. The way I'm going to do it is I'm going to credit cash on this one that we pay immediately. On May 8th, we decide to, maybe we had too much product and we're going to return some of it, say $300 of it. So we're going to debit accounts payable because if we're returning it, we don't have to pay for it. So we're going to reduce the accounts payable by debiting it and credit purchase return, or i.e. inventory. And then finally, they're taking an early payment discount here. And so they're going to debit accounts payable and credit purchase discount. I think my number is a little bit different than these on the whiteboard, but not much different. And then I'm going to add one more component. But anyways, so what you have here is inventory is what you ultimately paid for it to the seller, which is the sum of $3,800 less $370. That's what went to the seller. So that's $3,430 plus the amount you paid for freight in, $150. So what you paid to the seller, $3,430 plus the freight in, $3,580. That's your inventory balance. All right. Now let's try to. We'll walk through these. I've got these whiteboarded already for you. Okay. So some of these. So I had the entries sort of on the left, and then I had the T accounts on the right. So first one, debit inventory, credit accounts payable, $3,800. That's for the purchase of inventory. Let's see when we'll do this. So there's the $3,800, and there's the accounts payable for $3,800. Okay, easy peasy, right? We know that we pay it on account. If we pay for it in cash, the credit be the cash. Freight in, which we do not pay to the person who we're buying the goods from. We pay to a common carrier like Federal Express or Yellow Freight or UPS, and there's so many freight companies around, so it could be any one of those. But we as the buyer, we're paying for it, so it's a component of inventory cost. Debit freight in, credit cash. Of course, freight in is a component of inventory, so that goes debit to inventory. And we put the credit to cash down here. We decided we had in this case, we're going to return. You can return for a number of reasons. One would be that we had excess goods. We received the wrong goods. We ordered the wrong goods, but nonetheless, we want to return $300. The person we bought it from agrees to it. We debit accounts payable because we're going to reduce the accounts payable because we're not going to have to pay it because we're returning the inventory. We're sending the inventory back, so we're going to reduce the payable, reduce the inventory by $300. So debit accounts payable, credit purchase return, which goes to inventory. And then on number 4, for whatever reason, maybe we weren't fully satisfied with the goods, but we're going to keep them. But we say we'll keep them, but we want an additional price negotiation. So this would be a purchase allowance. Okay. So debit accounts payable because we're going to pay less, and this, of course, the seller has to agree to this, and credit purchase allowance, which is a component of inventory. So at this point, we have the initial purchase in the inventory balance, the freight in less the purchase return and the purchase allowance. And I drew subtotals for inventory and accounts payable, okay? And at this point, I have 3,550 of inventory and $3,400 of accounts payable. And the reason they don't balance, the difference is the cash that we paid. So at 3,400, I say, okay, but now I want to take a 2%. I'm going to take an early payment discount, 2%, right? So 2% of 3,400 is what I owe. So that's 68 at this juncture. And the difference between this and the prior slide is I added the reason it's different from the 70 on the Wiley slide is I added an additional entry, which anyway, so it's in this case it's 68. So we're going to reduce the payables because we're going to pay $68 less, and the credit and the early payment discount also goes to inventory. So the credit to inventory. So and that's all the transactions. So at this point we have accounts payable 3332, the credit. We pay cash of 150. That's also credit, and the debit is 3482. So it all balances, right? That's our ledger. It balances. And we should know that inventory is this, that balance in inventory is the sum of what we paid to the seller of the inventory, which in this case is 3332 plus what we paid for freight in, if we paid for any freight in. So that works. So those are your purchase entries. All right, we'll be back with your sales entries. Okay, now I'm back with the sales entries. I'm going to share the sales whiteboard. It's all whiteboarded. I'll walk you through it. So let me share that. Okay, so I'm going to take you through. There's a lot here, but we'll break it down. If you just focus on one piece at a time, it's not too easy. No, it's not too difficult. It's very easy, especially the way I explain it. So we will go on the sales side. If we sell something, we're selling a product now. So when it was service revenue, we would sell it on account, debit receivables and credit service revenue, and that would be that. But now when we're selling inventory, we have to make 2 entries. So in this case, we sell it for $3,800 on account, debit accounts receivable 3,800, credit sales revenue. But we're also shipping inventory out the door. So we have to reduce the inventory. So I made up a beginning balance of 10,000 of inventory. And the book says that the inventory associated with the sale is worth $2,400. So if it's shipped out the door, we have to reduce the inventory. So that's a credit to inventory. And then the entry here is cost of goods sold, right? Which is an expense, debit, which is the amount of inventory that goes out the door that's associated with the sale. So cost of goods sold, debit is an expense. It's on the income statement, right? It's a sales minus cost of goods sold equals gross profit, right? Debit cost of goods sold 2,400, credit inventory 2,400. And so you need both those entries to record the initial sale. You need the recognition of the receivable and the sales revenue, and then you have to reflect the fact that inventory is going out the door. All right. Now, just like on the purchases, the purchaser decides to return us some inventory. For whatever reason, they bought too much. Could be any number of reasons. Could be defective. We'll just say they bought too much, and the inventory that they return is good. Okay, we'll keep it simple. And they returned $300 worth at the sales price. So we're going to debit sales returns 300, which is a component of sales. It's going to be gross sales minus returns and allowances to get to net sales. And because they returned it, they're not going to pay us that $300 worth of receivables, so we'll reduce our receivables. But also, so anyways, that entry's debit sales return and allowance reduces the sales and it reduces the accounts receivable. But because they're returning inventory, we have to restore the inventory on our books. So in this case, I think it's the same ratio, whatever that is, 35, 40, maybe 45%, probably the same. I didn't do the math, but whatever it is, the inventory, the book value of the inventory is $140. We have to put that back in inventory. So we'll increase inventory by 140. And because it ultimately didn't go out the door, so it came back in the door, will reduce cost of goods sold. So credit cost of goods sold, and that's how you record a sales return. Where the product is actually returned, you have to reflect the sales and the receivables, as well as the inventory and cost of goods sold. All right. Now, on number 3, the buyer recorded a price reduction for whatever reason. Maybe the goods weren't what they hoped to be, but they're not returning any goods here. They're just impacting the price. So in this case, we only have to reflect the receivables and the sales returns. So we have 3 debit sales returns and allowances for 100, and then reduce the receivables by 100 with a credit right there. Okay. Again, nothing to inventory, because on this point, inventory did not move. So then I struck a subtotal here. So at this point on sales, I added all that up, 3,400, and receivables at 3,400. Okay. And I did that in order to compute the cash discount. So now the buyer decides to take that 2%, 210 net 30 discount, the early payment discount. So 2% of 3,400 is 68. Okay. So they just pay within 10 days. That's when we knew they took the discount. So they paid in time. So they paid less than the 3,400. They paid the 3,332, which is 98% of 3,400, reflecting the 2% discount. All right. So they we receive cash for 3,332. We get rid of the receivable because they don't owe us any money anymore. We make it all go to 0. And the sales discount is a component of net sales. So we debit that to sales. Okay. No impact on inventory here. So you don't have to touch the inventory account. In the 5th entry, we have freight out. In this case, I'm saying that we paid the seller paid the freight out. We know that's an expense. I said they paid in cash freight out, which is an operating expense. Debit that 150. Expenses and debit balances, and then we credit cash 150. Okay. So what's more important now is we want to calculate the sales and cost of goods sold, right? So we saw how the receivable. I'll walk you through how that all got down to 0. So our sales of 3,332, that's the gross sales of 3,800, minus the initial sales return of 300, that's this one here, minus the price negotiation of 100, and minus the early payment discount of 68. Okay, so your total sales of 3,332, which in fact is the cash that you receive from the customer. It should be the same thing. The 150 out to the freight, that's not part of sales. Okay, it's the cash that you receive from the customer. This is what you receive from the customer, and that should equal your net sales. Okay, now I subtotaled my 2 entries for cost of goods sold here. That's 2,360, but I can also do my proof. It should be calc, cost of goods sold calc, which I had beginning inventory of 10,000. In this case, I showed no purchases for simplicity. My ending inventory is 7,740, which reflects those transactions. And so when I do that, my cost of goods sold proof is 2,360. Okay, which should equal your T account. So that proof worked. And there was no room really to put it. Maybe I'll try to do it over here at the last second here. So now I have, it's going to be tight. Net sales. That's the 3,332. That's what you begin with at the top of the income statement. Okay. Cost of goods sold. And that's 2,360. And when you do that, take that, gross profit is going to be 972, I think. If I did it right in my head, gross profit's 972. Looks right. And then my gross profit rate is gross profit divided by net sales of, so 972 divided by 3332 is 29.1. We'll round to 29.1. All right, and that is, and then freight out would be down in the operating expense section. So that hopefully these purchase and sales whiteboards will go a long way to helping you. Have a great weekend, everybody. I'm not done yet. Hold on a second. There I am. All right, have a great weekend. What am I up to? Watch the Sox tonight with maybe a fire pit, long bike ride on Sunday, and spend time with my wife tonight and tomorrow. All right, so there you have it.